Hey, today I'm going to share my top 5 ETFs for 2025. If you've been looking for some ETFs to invest in 2025, this is the video for you. I'll share the symbols, the themes for the ETFs, and what's in them. I'll also at the end share an example portfolio which can beat S&P 500 pretty easily. If you're new to the channel, welcome to Investing with Shakib. I cover personal finance topics. My favorite ones to cover are options trading. If that's your cup of tea, please don't forget to subscribe and stay tuned. Let's get started. All right, so number one is SPY. I love SPY. It's one of the most popular ETFs. It's also one of the most traded ETF in the market. You can just check the daily volume. One of my most favorite thing about it is the daily options. I do RSI trading. If you have questions about how I do that, leave it in the comments. But my core strategy for investing in SPY is a combination of options and stocks. Yes, you can definitely just buy shares and just leave them so that they can grow over time. But when you do options and stocks combination, it can magnify the growth significantly. And again, I might actually make a video about that in terms of how I do that. But it's pretty interesting. And then I have some alternatives listed. QQQ, which is S&P 500, is 500 of them. QQQ is top 100, excluding financials. So a lot more volatile, highly focused on the tech stocks. And then VOO is same thing as SPY, just from Vanguard. If you don't want to buy SPY, you can buy VOO. And then VTI is just more diversified, focused on the total stock market. Okay. Going to number 2, USD. This is focused on semiconductors and AI. So as you can see, one of the top component is NVIDIA. I'm not one of those people who's still riding the AI hype train or whatever, but however, I do believe wherever we're heading in terms of technology, we're gonna have semiconductor stocks and AI focused companies. They'll be a big part of it, so definitely something to hold on to. The alternatives listed, if you notice they have asterisks, is because I just did not see any other good ETF offerings that were not leveraged. So SOXL and TQQQ, these are leveraged ETFs. They are very risky. However, they do provide 3x returns to a lot of the semiconductor stocks that are in it. So if those stocks go up 1%, this thing will go up 3%. And it'll also do the other way. If it goes down 1%, this will go 3%. So you definitely want to be very careful with those. Personally, I will stick with USD for my main portfolio. SOXL or TQQ, they could be a smaller portion. Okay. So a little bit of foreshadowing about number 3. There will be 2 options. First option is XLY. This is consumer discretionary. It's got a lot of staple companies that are not necessarily they're very diversified. There is no theme to it. And to give an example, Amazon, Tesla is a little, I would say outlier, but Amazon, Home Depot, McDonald's, Boeing, Lowe's, these are companies that are here to stay, at least for a while. And a lot of them, if you notice, are essentially dividend stocks. So they're here to stay, and they've done actually really well in the last few years. So definitely something to consider. This is the other choice, which is XLF. This is the financial sector, and these are all the big banks and companies that are big names in financial sector. So it's something like Visa, American Express, BlackRock, which is the biggest wealth management company. So yeah, those are what we have. The alternatives, VFH is pretty much the same thing, but from Vanguard. And KRE, if you want to invest in XLF, but you want to focus on regional banks, you can invest in the KRE. So it'll have banks like Citizens Bank, Truist Bank, Flagstar, Wellstar, all the other Regions Bank, those type of banks. and it actually did pretty well in the last few years, so definitely a contender. All right, moving to 4. Again, 2 choices. So number 4 theme is safe dividend. Why? Because this thing will give you dividend pretty safely, low risk of cutting, or there's also not a lot of chance of going it up. It's just a stable dividend providing ETF. As you can see, it's got a lot of really boring companies like Pfizer, Coca-Cola. These things, they don't really move, but they provide you stable dividend income. I think right at this point, it's providing something around 3.5. So if you invest $100, it'll give you $3.50 for the year. There's an alternative that is DGRO. It provides a lower yield, but it does have companies that will just move more. So for example, I think it's within its top 5, it has companies like Broadcom and Apple, so it definitely moves a lot more. Okay, moving into the other option, number 4, which is JEPQ. Now this one is aggressive dividend. It's from JP Morgan. The way they earn money to distribute as dividend is derivatives. So the fund managers will invest in options like covered calls and synthetic calls to earn income, and they distribute that as dividend. This provides something around 9 to 10% at the moment, but again, these are risky. Any dividend stocks or ETFs that provide the dividend by earning income from options are significantly more risky than something like the other one, which is SCHD, where it's very stable. So very risky. However, it's worth keeping a small position potentially just to get more higher yield monthly. Okay, we're moving on to the number 5. There's only one, and here's why I recommend this. It's just how I think the economy is going. So this is gold. The theme is gold. I think gold should be a core component of every portfolio, just because, you never know what could happen. It's precious metal, and it's not even precious metal. It's specifically gold, nothing else. It's backed by physical gold. Gold is not going anywhere, and when things go south, gold will save you. You're talking about a pandemic, financial distress, recession. Gold will keep you bulletproof, so you got to have some gold. Okay, so let's go into an example portfolio. If you had $10,000, you could invest them in these ratios, and here's how this portfolio would do versus if you just invested in SPY, the whole 10,000 in SPY. As you can see, this portfolio would do significantly better, at least in the last 2 years. It outperformed it. Sure, it's going to be more volatile than S&P, just because we have the components like the USD and JEPQ. However, at the end of the day, if you hold on to it, you should have more steady income from the dividend components, and also very good growth from USD. All right, so I think that sums up this video. If you have any questions, let me know. And as always, thanks for watching.